Good evening, class, and welcome to our advanced taxation class for today. Our topic for today is tax audit and tax investigation. My name remains Chima, your lecturer. Now, what do we stand to gain from this topic? One, we are going to see the purpose of tax audit and investigation. We will see types of tax audits. We'll also dwell on stages involved in tax audits. Then we will look at tax investigation, stages involved in tax investigation. So these are the major things that we will cover during this period because we are going to be focusing on what is relevant for your exam. Okay. Now, let's go to tax audits and tax investigation. Now, what are these tax audits, tax investigation? What are these? All right. First of all, let us look at what audit is before we take it to tax audit. When we say audits or statutory audits, we mean an independent examination of a company's or organization's financial record by an external auditor. And at the end of that examination, he will express an opinion whether the organization financial record presented is fair and accurate, whether its financial position is fair and accurate, free from material misstatements. Now, the thing is, this examination is usually conducted by an independent person known as an external auditor. So this external auditor is not a worker in the organization. He comes from outside and he conducts an official external examination, independent examination of the accounting books, record, and documents, which are the underlying documents that was used in preparing the financial statements. That is what we call a statutory audit. Now, statutory is something that is required by law. It means that for a company, it is required for you to have a statutory audit of your books. What are the objectives of a statutory audit? One, you want to express an opinion as an auditor whether proper books have been kept by the organization. So it means you're going to be checking if sales record is there, purchase book is there, cash book, bank book, what again? General ledger, expense record, asset register, what have you. So you want to check if proper books have been kept. Secondly, if the financial statements are in agreement with the books. For example, your financial statement is saying revenue is 1 million. Your underlying record is saying revenue is 1.8 million. Then there is a big problem. Or your assets register is saying that you have an asset worth 5 million located in XYZ area. And your financial statement is saying you have an asset worth 10 million located here and there because you want to claim capital allowance, more capital allowance to reduce your liabilities. Your financial statement have to agree with books that you've kept. So yes, it's not enough to keep all these books, but are the books correct? Record will be relying on them. Thirdly, the requirements of applicable
Like it's not
registration.
totally gone. Let me just put it that way.
Sorry?
It's not totally gone.
Like the pain is still there, you get.
Not getting
Have
you.
you called the GP?
I didn't call them all.
All right, so the third objective here is that the requirements of applicable legislation have been complied with. For example, we have CAMA 2020 now. Has CAMA 2020 be complied with when you are preparing your financial statement? So, if that, what about all the other standards? The IAS, the IFRSs, have they been complied with? This is what the statutory audit will check. So C and D is also the same. Applicable accounting standard, both local and international, have been adhered to. Then when everything has been checked, does this give a true and fair view of the state of the financial affairs as at the balance sheet date? So is it a true picture? Is it a true picture of what has happened in the company? These are some of the things that the statutory audit will do. Now, we have statutory audits, which is usually done once a year because, the costs involved in doing statutory audits are huge. So they are done once a year. But that is not the only kind of audit that is being done. There is something called specialized audits. Now, specialized audits are involved when a special attention is needed on a special issue that is not part of the objective of statutory audits. So it means that when there is a special issue, they will do a special audit to address that issue. Now, when a specialized objective that are achieved and in terms of reference. So for example, audit is a specialized audit because we are specifically checking for tax compliance. Let's say, for example, we want to check if a company is VAT compliant. So that is a specialized audit. All right. What is the legal basis for the power of tax authorities to conduct tax audits and in-tax investigation? Now, tax audits are similar to specialized audits. I mentioned that because they are additional to statutory audits and they are carried out by special people trained for that, which are tax officials from either the FIRS or the state's internal revenue. This is talking about Nigerian tax. And so the legal backing here is CAMA 1990 and other tax legislation that are being promulgated. So that's that. Let's now go to relevant aspects needed in your examination. Now, what are the objectives of tax audits? Previously, we saw the objective of statutory audits. Now, we say tax audit is like special audits. So they are going to also have a similar objective with statutory audits. For example, one of the objectives is to check whether adequate accounting books and record are kept for the purpose of determining your assessable profit, your taxable profit or loss, and the tax payable. So here, they are not just looking at your books, whether you are keeping books, proper books, whether the normal accounting policies are followed. They are checking if your record exists that will help them to determine your tax payable, which is the sole end. Then the tax computations that was submitted during your self as check if it agrees with the underlying record that you are keeping in your establishment. Then they want to also check whether your tax legislation, the tax legislation have been complied with. We have CAMA is also there. We also have the FRS Act. We also have the Finance Act 2019, 2020, 2021, and so forth, whether they have been kept complied with. Then there are other objectives that are not the primary objective. One of them could be an avenue to educate taxpayers on the various provisions of the tax law. So when there is a tax audit to a company, it's a way to educate them that will make their eyes open. Maybe there are some people before now when VAT was 5%, withholding tax was 5%. You know, when you issue an invoice and you add VAT, and the other party is supposed to withhold, and it's 5%. And so you withhold 5,000 naira, you add VAT of 5,000, they withhold 5,000. So they all cancel out. Many people do not remit it, saying that it has cancelled out, the head money is what is coming. And when they go into tax audits, it is a means to educate them that no, the fact that both of them are the same figure, they cancel out each other, doesn't mean that you are going to keep the money. You still remit. You remit the other. It became glaring when VAT became 7.5 and withholding tax was 5%. And so some people were saying, should we now only remit 2.5? No, it was a means to educate taxpayers, the provision of the law. It's also a source of discouraging tax evasion. So when you know that an official record or official examination of your record will be done, you will not evade tax because they will check your books, check what you have submitted, whether it harmonizes with the underlying record kept by you. And if they see tax evasion, they are going to punish tax evasion. And so because what tax evasion is taken seriously and punishable with stringent results, you may want to discourage yourself from doing it. Then sometimes it is not because of tax evasion that they are doing it. They want to also check, maybe there are some harmless, unintentional errors that may come, maybe error of transposition, error of overcast, undercast. For example, somebody wants to write 4,540. Somebody may write 5,450. sometimes it may seem alike, but do you know that one is bigger than the other? That is what they call either overcast or undercast error. So they want to check if there is mathematical error in the tax returns, and especially if that error is significant. We'll call it material. Okay. Then it also provides various provisions of the law and recommend possible change. Sometimes tax audits will lead to tax investigation or tax fraud. And so when they check in audits, they might find something criminal, something fraudulent, and they will recommend that investigation be done. And because you also know that tax audit will be done, it will forestall your failure to render your tax returns, which is also linked to tax evasion. So you know that they are going to check, investigate, so you will not fail to do the right thing. It will prevent the taxpayer from rendering incomplete or inaccurate returns, and it will encourage voluntary compliance, which is other objective of tax audit. Now, what are the differences between tax audit and tax investigation? Now, tax audit was introduced to empower relevant authority to conduct tax audits, and it is legally required to be done periodically to confirm the assessment being submitted by the taxpayer. Now, tax investigation is not something that is done periodically. It is only done when there is a recommendation, when there is a need, when they are being referred to, when they smell criminal acts or fraudulent acts. Now, the scope of tax investigation is wider than that of tax audits. So you see all those objectives of tax audits that we've mentioned, that of tax investigation is bigger. They are checking to see whether fraud was actually committed. And so the depth of work will be more than tax audits. Then tax investigation is carried out when there's a suspicion of crime or fraud. Meanwhile, tax audit is a routine thing. They can carry it out on every taxpayer. Tax investigation is conducted by tax inspectors, whereas these are not required for tax audits. And so the principal aim of investigation is to obtain evidence of fraud and tax evasion that will lead to prosecution of the criminal. Whereas tax audits is just, as the purpose of it is stated, to check whether the tax laws have been followed when determining your tax. Now let's look at types of tax audits. We have two types of tax audits. We have the desk audit and the field audit. What is a desk audit? Like the name implies, this is an audit done at the desk of the tax authority. It is sometimes called desk review or desk examination. Now, what happened is that as soon as you submit your tax returns, previously it used to be filing of hard copy. But now, when you go to the Tax Pro Max and you submit your tax returns, immediately or not so immediately, the tax review will start. They will take your file and check whether you completely filled it. After filling it, they will check whether there are errors in what you filled. And thirdly, whether accompanying documents and records can back what you filled. Now, the outcome of a desk review or desk audit is a query. Sometimes they will give you a query that is issued to the taxpayer stating the findings and requesting the taxpayer to respond to the findings. Sometimes they want you to supply documents to substantiate what you have submitted, maybe because you failed to submit. For example, you say your rent is 1.5 million. Where is your rental receipt? Where is your rent agreement? Maybe it was not submitted. They will want to know. Are you paying payee? Let us see evidence. Even the rent that you paid, show us evidence of withholding tax deducted. All right. So these are some of the things that the tax audit will be doing. So normally, it is not feasible for the tax officers to respond to all tax audits that are submitted. And so sometimes it takes a lot of time. All right. Let's go to field audit. When tax audit is not adequate enough to establish that your audit, the audit of your company is well done, field audits may also be involved. Now, field audit is when the tax officers leave their desk and carry the audit to the office of the taxpayer. So it is called field. So your office becomes their field. And so they need to carry out audits in the premises to enable them carry out their examination properly. It's just like saying that you have assets that you are claiming capital allowance. They will want to come and see that asset. You have an asset schedule and you say maybe this KVA generator is located in Gwagwalada, Abuja. They will want to go to that place and see it's located there. And sometimes, you know, it is encouraging that all your assets, you label them according to the company's labeling rule, you label them, and it is so labeled in the asset schedule, so that when they are looking at the asset schedule, they are also seeing the label there and the label in this on site. And so, oh, this is what you are referring to. That's fine. So you see here, there is a need for the tax auditors to carry out this audit in the premises of the taxpayers. Now, there are steps involved before a field audit will be done. First of all, they will need to select the taxpayer to be audited, followed by preliminary review of the tax file. Notification of the taxpayer follows. There's a pre-audit meeting. There's also an audit, post-audit meeting, interim report, post-audit review, reconciliation meetings, final report. Let's look at them. The first one is selection of taxpayer to be audited. How will they know the taxpayers to be audited? So there are several criteria that they can use to choose the taxpayer to be selected for audits. One of them could be that some taxpayers have not submitted self-assessment for the past 2 years, so they can pick them for audits. Why have you not submitted for the past 2 years? Sometimes The taxpayer might have so many withholding tax credit notes, and they want to know how do you get that. We investigate. Sometimes you are filing new returns on a continuous basis, or you have a continuous loss-making situation. How? You don't want to give the tax authorities money. Let us come to your place and see your books. Is it that you are making money and you are reporting loss? Then there is taxpayers with very low adequacy ratio. Adequacy ratio are all these financial ratio, gearing ratio, liquidity ratio. When they check your financial statement, they are checking all those ratios with a view to knowing the health of the company. And so when you have this low, unhealthy adequacy ratio, you'll be selected for audits. Then it could also be on routine industrial check. Just pick maybe any audits, any firm in that industry, you pick it along and you audit. It could also be based on information received from intelligence reports. It could also be transfer pricing arrangements. Also based on tax planning scheme, claim under DTA. It could also be because you have a secondary relation, you have a relationship with another company, maybe because you are a group of company, and so because they are auditing one company and you are in group, they are transacting business is a requirement, is also a reason why they want to audit the other members of the group. Also, it could be referrals. It could also be random sampling. Random sampling would just be that, okay, just be dropping your files. Every 10th file is for audit. So you drop file 1, you drop file 2, file 3, maybe the 10th file, you kept it somewhere. You're going to do this audit. So you'd start again 11, 12, 13, 14. The 20th file, you kept it again. So this is just random. You just like picking at random. Maybe they might be a raffle draw. They put all the companies in a raffle draw paper and they shake it, and you pick. And as you are picking, these are the companies that will be audited. That's random sampling. Then it could also be directive from a higher company or higher government authority. Now that the tax authorities or the tax auditors have known the company to be audited, they have chosen it whichever method they want to. What's next? They will review the taxpayer's file, each one of them. Now, what are they doing it for? It will prepare them for the audits. So they want to know the basic information about the taxpayer. For example, what is the taxpayer's name? What is his nature of business? When did it register for incorporated? When was it incorporated? When did it commence business? Has it changed its accounting dates? What are the directors? Who are the directors, rather? What are their portfolios? What are their stock in trade? We want to know everything about the company, about the taxpayer. Okay, so they are looking at to know his kind of business. Now, such that they are getting themselves acquainted with the taxpayer so that when they are speaking from the position of knowledge. Then there is preliminary activities. What are those preliminary activities? They'll be gathering the relevant files and grouping them into the number of audit teams to be established. For example, they might group some files that have, maybe they were collecting them based on random sampling. And then I say, okay, we have some oil companies, maybe 2 or 3. oil companies, we group them together. Then we might see one or two downstream sector oil, group them together. You might be doing banks, 2 or 3 banks come together. You might be doing manufacturing companies. So you group them together so that you will not say, okay, we have several audit teams. There is an audit team that is handling upstream sector, another audit team will handle downstream, another audit team will handle maybe technology solution company, another one will handle banks. So that's it. Then they will now acquaint themselves with the background information about their cases. What is the information about their case? So now they have knowledge about their company. Now, back to the business. What is the background information about their case? Is it that they have not submitted tax returns for 2 years? Is it that they are making losses continuously? What is it about them? Then, when they do that, they will prepare audit checks that will be used to ensure that every aspect of the audit is being carried out. So as they are doing, they are ticking the boxes, ticking it, because they are using it as a form of check. Right? Then design interview format. So the format of how they will interview the company, what questions will be there. Is it going to be orally? Is it going to be word of mouth, or filling this questionnaire, or is it going to be hybrid? Depends. Then they will assign specific duties to audit team members. So maybe the team members might be 5, and they will tell you, in this audit we are going, this is a leader, you will take the lead role, this is a supporting role, this is what you are going to do, this is what this person is going to do. So everybody knows their tasks in the audit. Now, looking at audit checklist, the complexity of some businesses warrants the need to be comprehensive when making audits. And the way to make a comprehensive audit without missing anything is when you have a checklist prepared in advance. So if there's a checklist, you all be ticking the boxes to ensure that you have completed the audit. That is the work of audit checklist. Then we have background information. We need to know name of company. We also need to know registered address. There's a difference between registered address and business address. The registered address is the address you give the CAC people. The business address is where you are actually operating from. Date of incorporation is there. Date of commencement of business. What is their tax file number? Nature of business. External and internal auditor, consultant to be looked at. Bankers' address, solicitors and secretaries, all of these. These are some of the things that will be in the checklist. All right. Then analytical review of tax returns. Now, here, the officer in charge will now use the following record to determine the taxpayer's performance. Last audit or investigation, if any. You produce the last audit, you use it to check the current audits. Then financial statements, which will include the chairman's or director's reports, auditor's reports, statement of financial position, and statement of comprehensive income, then the statement of cash flow, notes to the statement. These are about the 4 that is analyzed. The tax returns. So the tax returns will now have to be checked if it tallies with what you have submitted, and if it doesn't, let us see where there's a discrepancy. Then there is the ratios. We said before, adequate ratios. Now, the adequate ratios is these are they have like 3 or 4 branches. We have liquidity ratios. So this tests whether your company is liquid. So we have the current ratio, asset test ratio, working capital turnover, and assets turnover. Both of them are inverse of each other. We have efficiency ratio to know whether you are really doing well, whether you are efficient. Receivers to turnover ratio, age of account receivable. If your account receivable are all over 30, maybe between 60 to 90, how many of them are there? Or how many of them are between 0 to 30? This is age of your account receivable. Inventory turnover. How many days does it take you to, sell your product and restock? That is the turnover of inventory. Working capital turnover and assets turnover. So that's it. Then we go to equity position and coverage. These ratios measure the balance between the resources provided by the creditors and the owners. So they're going to check debt equity ratio. We have the debt to asset ratio, book value per ordinary shares. Then we also check profitability ratios, profit margin on sales, return on investment, on total and on sales. Okay, then we have ratio of tax already assessed to net profit and all that. Now, the tax auditor should bear in mind that people do not want to pay tax. And if given the chance, they will want to evade tax. And if you are forcing them and they cannot run, they want to underpay. And so they should bear in mind that part of the things individual will do, they will want to understate your income. So if you're having an income of 1 million, you are stating 700. That is understatement. They want to check if you are really understanding what you're doing, or whether you are just evading tax. Now, another one is overstating expenses, especially allowable expenses. If your expenses are too higher than what it used to be, if it's too high, you may be having many allowable expense and you will not give adequate tax returns. Then undervaluing of stock. When you undervalue your stock, your closing stock, you are going to have lesser profits. When you have lesser profits, you also have lesser tax. Then you have secret reserves. If you create secret reserve, you need to bear in mind that people do that. Sometimes, some people will say it is only the account that is functional from 8 o'clock in the morning to maybe 3 o'clock in the afternoon. The second one that is running from 3 or 4 to close of business, sometimes things go into there and they are not being accounted for. Post-dating sales. Okay, post-dating sales. And also omission of income. These are some of the things that the auditor will check. Now, notification of taxpayer. When all of these has been carried out, all the checkings have been carried out, and the audit is it's a good thing, and there's substance to that, you need to notify the taxpayer of the preliminary review of the company. You're going to route it through the head of audits. And the taxpayer or his consultant will be notified that a field audit will be carried out on company's premises. Then we have the pre-audit meeting. When the auditors now come, they will have a pre-audit meeting with the management of the company. The managing director will be there, or other representative like finance director. Now, the tax accountants are expected to be there too. Now, the aim of this pre-audit meeting is, one, to inform the taxpayer of the purpose of the audit. So they need to know the purpose. They also need to confirm some of the background information from the taxpayer, because this time, before they come, they were doing their own background information of the company by themselves. So they want to be sure what we have done. Is it in line? Is there anything that we need to know that we have not known? We'll take it from there. Then we also have getting other relevant documents or information that is fine. That's fine. Then familiarizing themselves with the company operational system and what have you. Then give the opportunity for the management to express their view about the audit. Now, make notes, you have not started the audit, but you have become so knowledgeable in the company that you are asking them to confirm what you know about them. They are confirming. Somebody is talking. All right, so we have the actual audit. The actual audit is done properly at the company's premises. Then when the audit is completed, there is a post-audit meeting. This is held immediately after the audit between the tax auditors and the taxpayers or their representative in the taxpayers' premises. And so the purpose of the meeting is to obtain any further outstanding information that may not be available to the tax authorities, that is only available to the taxpayer. And so we need to find out. Then they will have interim audit reports. So they will prepare a preliminary report. Then they will now bring an interim report and submit. Then there will be a post-audit review by headquarters. And when that is done, there's going to be a reconciliation meeting whereby the taxpayer is called upon to come and reconcile some things, some issues with the tax auditors. Okay, then the actual final report is written and it is sent to the client. So that's about tax audits. Now let's go to tax investigation. Let's go to tax investigation. Now, tax investigation, we said, is different from tax audits. And they are only called for when there is a particular problem of fraud, large fraud, or criminal act is perpetrated. And they are going to be called on to investigate to see for possible prosecution and arraignment. All right, so the scope of work will be bigger than that of the audits. Okay, what are some of the things that could trigger tax investigation? One, failure to register for tax purpose. So you register your company with CAC, you've gotten certificate, or you don't have certificate, and because of that, you refuse to register your company for tax purpose. That's bad. Secondly, you refuse to file annual returns. The third one is refuse to allow access to your books and record. Maybe because you you know that something is being cooked there. You know that if they look at that, they're going to find you out. And you deny them access. Then you know that abusive tax schemes or aggressive tax avoidance scheme is being pursued. And when it is aggressive, there is no line between aggressive and tax evasion. Then suspicion of fraud, denial of tax audit, denial of access of the tax audit exercise. Other things also lead to tax investigation. It could be as much as refusing to file withholding tax. What are the stages of tax investigation? The first one is surveillance. So surveillance is pre-investigation activity. They will put surveillance, they will tell you, they will follow you. They are surveying you or the company to see whether there is substance to what they are hearing. Then the next thing is when they have gotten substance that they can work with, they notify the taxpayer. So the taxpayer needs to be notified that an investigation will be coming up formally in his residence. So the taxpayer will be aware that now he's been investigated. Before, when surveillance is being done, nobody is telling him anything. Now, notification of taxpayer, because the taxpayer will be aware it's being investigated. Then there's a pre-investigative meeting, which is similar to that of pre-audit meeting, where they will sit down, they will ask the managing director or his representative about the tax situation, about the company as a general. They want to ascertain certain things that they have learned about the company by asking. The meeting is aimed at informing the taxpayer of the purpose of the investigation, confirming what they have obtained from their surveillance, familiarizing themselves with the company's operations, and what have you. Then, evidential audit or investigation. Now, once pre-investigation is concluded, the investigation or the investigators will move in and start their work. They will investigate the premises and they will conduct an in-depth tax investigation. So then we have when they have considered and done the tax investigation and they find out that someone has been committing crime, they will now prepare a case for the person. They have built a case and they will now prepare the case and take it to the law courts. So the person has to answer for his error. Then there is an arraignment. When the person is found guilty, he is arraigned and taken to sentence is given. But arraignment also means here that evidence from the witnesses leading to prosecution and all evidence collected and witness secure and are made available when needed by the prosecutor. Then sometimes during the investigation, during the arraignment and all that, you find out that this is not a case of criminal mind. It is not a case of they set out to defraud somebody. Okay. So when that is done, yet you are not a criminal, they cannot prove crime, then, or they don't have enough evidence, they will terminate the investigation. And when they terminate the investigation, the case stops. Or if the suspect dies or becomes mentally unfit, then they will terminate the investigation. So that's it. So these are some of the things that will be coming out in your examination, which is what I've just discussed with you. The relevant items that will come out in the examination. Okay. Let me see something here at the end. So there's something called power of search and seizure, where the tax authority has reasonable grounds to suspect that an offense involving either any form of total or partial non-disclosure of information that is needed, or any irregularity or any offense in connection with tax that has been committed or can be found in the premises, the tax authority may authorize its officers to enter that premises by force, if possible, and conduct a search. These ones are usually carried out by law enforcement who not government workers that are not armed. Now, upon entering the premises, the officers may seize and remove anything that they find in that place. They may come and remove anything that they find there and use it as evidence for the purpose of proceeding, court proceeding or case proceeding. If they are arraigned the person, they are bringing him to book. Now, an officer authorized to carry out such a search and seizure may execute any warrant by calling to his assistance any police officer, and it shall be the duty of the police officer to aid and assist him. And so that's it. We have come to the end of today's class. The brief one, we've learned tax audits. We saw that tax audits are two types: field and desk audits. We also saw the steps involved in tax audits, and we also saw tax investigation. We saw the steps in tax investigation, and we compare tax audit and tax investigation side by side, and we find out that one of them has more scope, more detailed work, and leads to prosecution of the offender, while the other one is just a routine thing and will not take much scope as the tax investigation. Then we also saw the seizure, breaking in and seizure, that the law permits the tax inspectors or investigators to do. So far, so good. We've come to the end of today's class. It was a beautiful class today. In our next class, we are going to dwell on another topic that is very interesting. You will not want to miss that. Thank you so much for coming to class today. And if you have any question, this is the best time to air your question. Right, I can see no question. In the absence of any question, we will want to take a bow today from the class. Thank you so much for making this class very fruitful one. See you again in our next class. Have a nice day.